Hey everybody, Melissa Harmel here, Realtor with eXp Realty, Alaska. It's episode 6 of the Home in Alaska show, and I'm so excited to come to you today and talk with one of my favorite Alaska home loan professionals. Today's topic: how does my credit score affect the interest rate offered during the loan process? Hey Rhonda,
Hey,
how are you today?
Melissa. I'm doing great. Doing great.
So great to see you again. Hey, can you share with the viewers how long you've been doing mortgages?
Yeah, I am pushing nearly 40 years of doing mortgages. So I started back in the early 80s. And wow, have we seen a lot of different cycles over that amount of time, as have you, right?
40 years, yes. Well, I got my license, real estate license in 1998. So not 40 years, but I'm up there.
Yeah,
And we've
yeah.
been working together, what, 15?
At least 15. Yeah, yeah, yeah.
So I don't know about you, but over the past few years, as I'm working with buyers, I've noticed that sometimes the buyer's interest rates offered during that pre-qualification process are really different. Like sometimes a buyer was offered a 2.5%, another buyer offered 4.25%.
Mhm.
So can you explain why, if I look online today and it says interest rates are 4%, why not every buyer is offered that generic, better word, generic interest rate?
Right. So that's a really great question. So let me help clarify that for you. So we used to operate, and I know you remember this, we used to operate under this kind of two bucket system, right? So if your credit score was 620 or below, you fit into this bucket and you had these different types of programs available to you. And if you were 620 or above, then you fit into this bucket and you had those types of programs available to you. And they had very different pricing. And then here after the 2008, 9, 10 era, the 620 bucket, 620 and below bucket is gone. It does not even exist anymore. But what they did, every time there's a foreclosure, they analyze it and try to find out why. So why did this fail? Why did this homeowner fail at making their payments and not be able to stay in their new home? And so they analyzed that, and one of the big pieces was credit. So, what kind of risk are we taking with a lower credit score? And the risk was significantly higher with lower credit scores. So, as a lender, if I'm going to loan you $1,000 and I see that you're kind of hit and miss with your payments, whether you're going to pay me back on time or not, I might ask for a little bit more in return because I'm not betting on a sure thing here with you. But if I see that you're really good at making your payments every single month no matter what, it never fails, then I don't have as much heartache and risk and worry whether you're going to pay me back. So I'm going to give you a better rate. So here's kind of how it works. You fit into that 620 and above bucket got separated out into a whole bunch of buckets, and they're all labeled with a range of credit scores. So it's like every 20 points, right? 620 to 640, 640 to 660, 660 to 680, all the way up to 740. Once you hit that 740 and above bucket, you're kind of in one of the best buckets that we have right now. But if you're in that 620 to 640 bucket, you're deemed a higher risk because your history shows you might not be just perfectly on time all the time making all your payments. So we're going to get a higher rate of return for that higher risk.
And so in show 5, we talked about credit score tips. So
Mhm.
again, that if you have questions as a viewer about how to improve your credit score based on, now that Rhonda describes these different buckets, you should listen to that show, because Rhonda, it sounds like having the better credit score, and what was it? Did you say 740, getting it up to?
Right, 740 is kind of the best bucket right now, but keep in mind this bar changes all the time. So today, the best bucket sits at 740, but that could absolutely increase. One more thing we should probably clarify is that sometimes people will check their own credit report, right? And I've had clients come in and say, well, I have a 900 credit score. Well, we know that the credit score scale goes from 350 to 850. So why are they lying to me? But see, the thing is that they're not lying because there's two different scoring models. There's the FICO model that most lenders use, and then there's the Vantagescore model. And that model goes from 450 to 950. And so they're not mistaken. They're not telling the truth. It's that they're using a different model than what most of the lenders use. So you want to be careful with that when you're checking your own credit score, is to know what model they're giving you, because you could have some false hopes a little bit that you have a higher score than what we think you do.
Well, and in my experience in dealing with buyers is oftentimes that conversation of, well, no, my credit score is great, until you go to pull that FICO credit score. And
Right.
then based on that FICO credit score, that might not be true.
Yeah, you're absolutely right. Now, Melissa, those buckets affect not only your interest rate, but if you have a mortgage loan where you need mortgage insurance, so you're putting 3 or 5% down on a conventional loan, and mortgage insurance is another topic I know we have coming up, but they also use that multi-bucket system for the mortgage insurance. And so not only if you have a lower score may you be paying a higher interest rate on your mortgage, you may also be paying a higher rate on your mortgage insurance premiums. And so it can affect a lot of different things. So one of our big goals is always to help give that education and help improve that score as quickly as we can to help get you into some of those higher buckets.
Wow, that makes sense. So different loan products or different components of the loan are based on the interest rates that you can make available because of those credit scores. So credit
So
scores not only affect the interest rate offered, it also affects, if I'm not putting 20% down, it affects possibly what my mortgage insurance payment will be monthly.
right. And so that's exactly why when somebody calls me up and says, hey, what's today's rate? I can't tell you. I don't know enough information. That would be like going into the doctor and saying, I have a headache, give me some morphine. You know, they can't do that. They need to have more information. They need to know what's causing the headache. Well, the interest rates are the same thing. I need to know what's going to cause that interest rate for you depending on your individual picture. Now, there are some loan programs that don't have these multi-bucket systems. So for example, Alaska Housing. So you could look at an Alaska Housing rate sheet, and it doesn't matter if you're at a 620, a 720, or an 820 score, everybody gets the same interest rate. So if I have some lower scoring borrowers, that's always a go-to option that I look for to help get them that better interest rate with a different loan product. The government loans like FHA, VA, USDA don't have such a small little spread on the multiple buckets. So yes, if you're down a little bit lower, you're going to pay slightly higher than a higher interest rate, but it's not so critical and not so specific as the conventional loans. So we're always going to be looking for those alternatives for you to try to find that right product for you. So the thing is that it's not always just about the rate, it's about the overall picture. So if you only have 3% to put down or 3.5% down to put down, but your score is in the low 600s, then I might go ahead and switch you over to an FHA loan where I can get you a better interest rate and the mortgage insurance isn't affected by your credit score because it's the same for everybody. So it's very difficult to say today's rate is, because it could be as different for you as it is for me, as it is for any one of our clients.
And it usually is the question I get, but I don't understand, Melissa. I went to get pre-qualified. And when I look online, rates are at 3.75, but the lender told me my interest rate's going to be 4.5.
Right.
So this explains that it's based on my credit score,
Mm-hmm.
and that impacts really what the interest rate will be. So if nothing else, viewers, you need to be listening to what Rhonda's saying, and you need to be really partnering with a mortgage loan professional who is going to share all of these things with you. Again, makes so much more sense. So if you were to listen to show 5 and learn about tips and tricks to improve your credit score, work with Rhonda to do that. You have to do the work, not Rhonda. Then she can put you in the different buckets and see which loan program would work for you with the best interest rate out there once you do increase that credit score.
Right, right. And even if it isn't, even if we don't have an opportunity to increase it fast enough, then, just remember that this probably isn't your last home. This is a home in your life. And so even the worst rates that I'm seeing right now are better than what my first time home buyer rate ever was. So it's still not bad. It's just not as good as it perhaps could be, but we can get you there.
Okay, so wow, Rhonda, great information. Again, just helping viewers understand what's going on in the mortgage industry and how interest rates are affected by your credit score. If you follow me here on YouTube or Instagram or wherever you're watching this, I'm a big believer in sharing information that you can use in order to make the right decisions. Rhonda and I do a show weekly. So if you have comments, please add them in the comment section at it below and let us know. If you have questions you'd like us to answer, you can either put them in the comments or at the end of this video, you will see both of our contact information. Feel free to reach out via phone, email. Rhonda has a Calendly link on her website, so you can actually schedule a time to meet with her and chat with her and have her answer all of your questions. Again, we'd love to hear from you. Let us know if you do have any questions. And Rhonda, I'll see you next week.
All right, see you next week.